Gold isn't cooling off, it's tightening like a vice, and the paper market is acting like it can talk everyone out of seeing it. Because the real story isn't the headline print. It's the plumbing, it's the financing. It's the spread that keeps whispering something uncomfortable even when spot looks polite. And if you understand that one hidden detail, you'll know exactly what level matters next. Why the next 1 to 2 weeks are a trap for impatient traders, and what would have to break for this whole setup to fail. But first, we have to deal with the trap baked into that number you keep hearing, 2,210. If your brain is still anchored there, you're already trading the wrong movie. That figure became a psychological line in the sand in a different phase of this run, back when new highs still felt like a surprise. But right now, the recent price context has been living far above that, with spot trading around the mid-4,000s and pushing fresh highs into late 2025. That's not a small difference. That's the difference between a market that's breaking out and a market that's already in the part where liquidity thins and a reflexivity takes over. And that's where the real pressure starts. Because when price is already elevated, the question isn't, can it go up? The question is, who is forced to do what if it goes up another 2% or down 2% in a single session? That's the battlefield. And it's why you're seeing the weird split-screen behavior. Confident forecasts on one side, oddly cautious silence on the other, and a market that seems to ignore the comforting narratives. That's not random. It's incentives. It's risk management. It's market structure doing what it always does when a crowd is leaning the wrong way. Now, you've probably seen some version of the story that Goldman turned bullish, flipped long, while Citi feels quiet. I'm not going to pretend I can see inside any bank's book in real time, but I don't need to. Because what matters is what happens when a major institution publicly tolerates a higher regime. That changes how other players behave. CTAs get braver. Asset allocators stop waiting for the perfect dip. Volatility sellers get tempted. And the whole market starts to treat pullbacks as inventory to scoop, not danger to avoid. But that's not the part that matters. The part that matters is what these narratives do to positioning, right when the calendar is about to step on the gas. And yes, the calendar is the catalyst. Not as a vague, something might happen soon, but as a tight cluster of events that repeatedly turns gold into a stress test. Mid-month options and positioning windows, a major inflation print, and then the central bank microphone. When liquidity is thin and everyone is hedged for the obvious outcome, the non-obvious outcome is the one that moves price. And that's where you make or lose months of performance in a week. So let's turn this into a clean framework. No mystical stories. Just mechanics, proof, and a roadmap. Start with the most honest thing you can say about gold in a high volatility regime. The market is widening its range. That's not bullish or bearish by itself, it's unstable. You can see it in the way rallies don't just climb, they jump, pause, and then lunge again, and sell-offs don't drift. They snap lower, shake out leverage, and then bounce before your emotions catch up. That pattern is the fingerprint of forced behavior. Somebody is being compelled to act. Somebody is selling because they have to, not because they want to. And somebody is buying because they can't afford not to. Here's one street-level symptom that proves this isn't just sentiment margins. When exchanges raise margin requirements in precious metals, that's not a moral judgment on price. That's a safety valve. It's basically the venue saying, volatility is rising, leverage is too hot, and we're going to force you to post more collateral. In plain terms, it squeezes the weakest hands first. It forces liquidations. It can create a sudden downdraft that feels like a narrative reversal, even when nothing structural changed. And then, when the forced selling is done, the market often rebounds harder than people expect. Because the dip wasn't a change of mind, it was a margin call. That's why you can be right on the thesis and still get emotionally wrecked by the path. Keep that in your pocket, because in a minute we're going to build the psychology shield you actually need. But first, the hidden detail. The one underappreciated mechanism that reframes this entire story. The price can lie for days, but the spread has to tell the truth every minute. Spot is the headline. The spread is the diagnosis. When gold is genuinely tight, when it's not just people want it, but the system is struggling to finance and move it, the stress shows up in the forward curve, in leasing, in basis behavior, in the subtle tension between paper promises and physical availability. Or, most people stare at a chart and argue about lines. Professionals watch the plumbing because the plumbing is where participants are forced to do things. And if you get that, you stop being shocked by weird moves. You start anticipating them. Here's the simplest model. Futures are a promise. Physical inventory is a constraint. Financing is the bridge between the two. If the bridge gets stressed, arbitrage gets sluggish. When arbitrage gets sluggish, price discovery gets jumpy. And when price discovery gets jumpy, volatility isn't a side effect. It becomes the tool the market uses to transfer risk from one balance sheet to another. That's not conspiracy, that's structure. Think about what has to happen for paper and physical to remain aligned. In theory, if paper gets too high relative to physical, sellers can short paper and deliver physical later, capturing the carry. If physical gets too tight relative to paper, buyers can demand delivery or source physical, or shift into products that force the market to acknowledge scarcity. But in the real world, there are frictions. Delivery windows, eligible versus deliverable inventory categories, logistical bottlenecks, refinery throughput, shipping constraints, and the fact that availability isn't binary. Metal can exist and still be unavailable at the right place, in the right form, at the right time. And that's where things get spicy. Because when the market is calm, these frictions are background noise. When the market is stressed, these frictions become the story. And if you've ever wondered why gold sometimes moves like a macro asset and other times moves like a commodity with supply constraints, this is why. Same instrument, different regime. Now we stack proof, not one argument. 5+ layers minimum, because this audience doesn't do faith. First proof layer, chart structure without worshiping it. In the recent regime, gold has been carving out a pattern that matters psychologically. Sharp impulses into new highs, fast pullbacks that look terrifying, then rebounds that reclaim key pivots. The exact number matters less than the behavior around zones. The zones I'm watching are simple. A near-term pivot zone around the mid-4400s, call it roughly 4,220 to 4,450 as the decision shelf. If price can hold above that on pullbacks, it tells you dips are being absorbed quickly. Below that, the market starts sniffing for a deeper retest. The next support zone sits lower. Think 4,300 to 4,320 as an area where you'd expect buyers to show up if the thesis is intact, because that's often where late buyers stop panicking and bigger hands start scaling. Above, the breakout tension is in the 4,600 region. If gold pushes into that area and holds, you change the game from trend continuation to potential squeeze behavior, because the market starts hunting stops and dealers start chasing hedges. And if that level breaks cleanly with momentum, the next extension targets are not polite, think 4,700s, and then a psychological magnet around 5,000. Not because 5,000 is magical, but because round numbers are where hedging flows and public attention collide, and that collision is what creates air pockets. But that's not the part that matters. The next detail is what flips the whole setup. Second proof layer, the macro driver that keeps getting misunderstood. Gold's fuel isn't superstition. It's the math of real rates, currency credibility, and tail risk pricing. When markets oscillate between rate cuts are coming and rate cuts are delayed, gold becomes a lever on expectations. If cuts are priced in, opportunity cost falls and gold breathes easier. If cuts are pushed out, gold can still hold up if the reason is inflation credibility stress or geopolitical risk. That's the key. Gold can rise in both growth fear and credibility fear, but it rises for different reasons, and the path is different. In a credibility stress regime, the dips are violent because policy expectations whip around. In a growth fear regime, gold can grind. Right now, the market is flirting with both narratives at once, which is why volatility is elevated. And volatility is not noise, it's information. Third proof layer, institutional behavior and the power of permission. When a major house is publicly comfortable calling gold a high conviction long, it gives other institutions social permission to re-rate their own risk. That's not emotional, it's career risk. Nobody wants to be the last one to acknowledge a regime shift, and nobody wants to be the first to look foolish if it fades. So you get this staggered behavior. One bank goes louder, others stay careful, and the market itself becomes the voting machine. That SY City quiet, as a narrative matters, even if it S not literal silence. In cautious houses, the base case messaging often stays conservative longer, because their job is to protect clients from drawdowns and from narrative whiplash. And in a regime like this, being right on direction but wrong on timing can still get you fired. That's what people forget. So if you see divergence in bank commentary, one sounding bold, another sounding cautious, don't treat it like a scoreboard. Treat it like a volatility forecast. Divergence in messaging usually means the range of outcomes is wide, and wide outcomes are exactly when spreads and options mechanics start to dominate. Fourth proof layer, the physical paper tension signal. This is where the hidden detail becomes usable. In tight conditions, you can see stress in the relationship between spot and forward pricing, and in the incentives around borrowing metal. If it becomes expensive to lease gold, or forward points behave oddly, that ents the system telling you physical is in demand relative to financing conditions. Even without quoting a specific number, the concept is everything. When financing tightens, the cost of carrying positions changes. Arbitrage becomes less smooth, and people who rely on that smoothness start getting surprised. And surprises create forced buying. Because if your hedge assumes you can roll something cheaply and suddenly you can't, you have to adjust. Fast. And that forced adjustment shows up as sudden bids at moments you didn't expect. Fifth proof layer, global comparison and the idea of where the stress travels. Gold is global, but it doesn't behave globally in a perfectly synchronized way all the time. Stress often appears as a location and form problem before it becomes a price problem. London versus New York delivery dynamics. Refinery constraints in converting bars into deliverable forms, and the timing of delivery windows can all create a moment where price should be X, but the market can make it happen smoothly. Again, the price can lie. The spread tells the truth. When that plumbing tightens, price action becomes more discontinuous. It jumps, it gaps. It does that thing that makes people scream a manipulation on both up and down days. The sober translation is simpler. Liquidity thins, dealers widen, and participants who need immediacy pay up. That's the mechanism. Sixth proof layer, the on-the-ground symptom that matters for you as a retail watcher. Not what some influencer says, but what the market forces people to do. When volatility rises, exchanges raise margins, brokers tighten risk, and anyone using leverage becomes a potential forced seller. That means you can get perfectly good dips that feel like the world is ending. That also means the market can squeeze higher when those forced sellers are gone and the remaining holders are more patient. In other words, volatility is both the weapon and the proof, and that's exactly why the next 1 to 2 weeks matter so much. Here it's the why now trigger in plain language. The calendar is about to concentrate attention and compress decision-making. You've got a major inflation print, you've got a central bank meeting shortly after, and you've got the kind of positioning windows where options hedging and month flows can shift fast. In those windows, the market doesn't gradually decide. It snaps, because risk managers don't wait for perfect information. They wait for thresholds. And when thresholds hit, they act, all at once. That is why you see the market do something that feels illogical. It can rally into a data release, sell off on good news, and then rally again the next day like nothing happened. That's not mood swings. That's hedges being unwound and reestablished, and liquidity being rationed. And if one level breaks, the math changes. Which brings us to the options reflexivity cameo, the part that most people skip because it sounds technical, but it's actually simple if you keep it human. Dealers and market makers who sell options often hedge their risk by buying or selling the underlying as price moves. That hedging can either dampen moves or amplify them depending on where price sits relative to big option strikes, and whether the market is in a positive or negative gamma environment. Translation. In some conditions, as price rises, hedgers have to buy more, which pushes price up more, which forces more buying. That's a loop. In other conditions, hedgers sell into rallies and buy into dips, calming things down. Here's why you care this week. As gold presses into big psychological zones, the market can flip from controlled to chase faster than your feed can update. That's why you never want to base decisions on a single candle. You want zones, confirmation, and invalidation. Now, let's talk about the title's drama without stepping into cartoon certainty. City silent. Goldman flipped long. These are narrative signals, not holy scripture. The real story is the pressure these signals create on everyone else. If a big institution is visibly comfortable with higher prices, then anyone who has been underallocated to gold suddenly has a career risk problem. If gold keeps rising and you didn't participate, your performance looks like negligence. So those managers start looking for dips to buy, not reasons to avoid. That changes the character of pullbacks. And then the other side, the skeptical crowd, starts looking for proof that it's fake, which ironically creates the conditions for a squeeze because skeptics supply the shorts that become future buyers. That's reflexivity. The market turns disbelief into fuel. But here's the crucial nuance. Disbelief doesn't guarantee a squeeze, it just sets the stage. The catalyst is always a forcing function. An event, a break, a liquidity vacuum, a margin shock, a delivery window, a sudden change in financing conditions. And that forcing function is exactly what the next 2 weeks can deliver. Now we have to respect counterpoints, because this is how you keep your credibility and your capital. The fastest way to lose money in a bull market is to assume the market owes you a straight line. Even if the thesis is correct, gold can whip around violently. It can fall hard on a day when the long-term story got stronger, simply because positioning got too crowded or leverage got too confident. Margins can get raised again. Policy expectations can flip on a single phrase. Geopolitical risk can de-escalate temporarily, pulling safe haven bids back. And yes, big banks that sound cautious can be correct about a drawdown even inside a secular uptrend. That's not a contradiction. That's a time horizon mismatch. So don't turn this into religion. Turn it into a plan. Here's the 2-scenario lens that keeps you sane. Scenario 1 is the controlled pullback and retest. In this path, gold dips, maybe sharp, maybe ugly, but it respects a support zone, it stabilizes, and it reclaims the pivot shelf. That's the healthy path, because it burns off leverage and resets funding stress without breaking structure. In this scenario, you'll see volatility spikes that get faded, and you'll see the market stop responding dramatically to every headline. The tell is simple. Dips get bought faster than they can form, and rebounds reclaim the mid $4,400 area with authority. Scenario 2 is the continuation squeeze. In this path, there is no generous retest. Price holds the pivot shelf, grinds, and then punches through the next resistance zone. Think the 4,600 region, and instead of reversing, it accelerates. The risk here is gap risk. You wake up and the market is 5% higher, and the only sellers are too scared to step in. That's when you see the "it's overbought" crowd get steamrolled. Not because they're dumb, but because the loop forces buying. That is also when you see the ugliest psychological manipulation. The market convinces you relate. Then it slams you with a rug pull. Then it goes higher without you. That's the game. And that's why your framework matters more than your prediction. So what's the hidden detail you actually watch to decide which scenario is forming? Watch the plumbing, not the pundits. Watch whether financing stress is rising or easing. Watch whether forward pricing feels normal or starts behaving like inventory is more precious than paper suggests. Watch how price reacts to event risk. Does it sell off and instantly get bought, or does it sell off and stay offered? And watch the behavior around those zones. Because in markets like this, the levels aren't magical lines. They're where different classes of participants are forced to act. If price is above the mid 4,400 Oz pivot shelf and holding, short-term sellers get nervous and buyers gain confidence. If price loses it and can't reclaim it, the market will test who really has conviction. If price breaks down into the low 4,300s and holds there, that can still be constructive if it's a retest that finds real bids. But if price slices through support and rebounds are weak, that tells you the market is not just shaking out leverage, it's shifting risk. That's the invalidation logic. And it matters because it keeps you from making emotional decisions based on a single red day. Now let S pull this back to the metals, commodities crowd, S' favorite battleground. Paper versus physical. People love to talk about it like it's a moral war. It's not. It's a timing and constraint problem. Paper markets are amazing at providing liquidity and price discovery when everyone trusts the bridge. Physical markets impose reality when the bridge gets stressed. The tension isn't fraud. The tension is that promises can be created faster than metal can be mined, refined, shipped, and delivered in the right form. And when demand surges or financing tightens, that mismatch gets exposed. Sometimes it's exposed as a premium. Sometimes it's exposed as a delivery scramble. Sometimes it's exposed as a weird curve move that only the nerds notice. But the nerd signals are often the earliest warning. And right now, the nerd signals matter because of the calendar. A thin liquidity window plus event risk plus a market sitting near major zones is when those signals graduate from whisper to headline. And that's where the real pressure starts. Now, what about the city silent angle? Why it matters psychologically? Because in regimes like this, the public narrative often lags the market. When price moves first, the cautious institutions don't want to validate it too early. They wait for confirmation. They wait for the pullback that proves it's real. That caution can create an information vacuum where retail thinks, if the big names aren't screaming, it must be fake. But the market doesn't care about your comfort. In fact, the market loves your discomfort because discomfort is what keeps you from holding a position through volatility. And institutions know that. Volatility is how positions transfer. It's how weak hands get separated from strong hands. It's how leverage gets punished. So the psychology shield is not optional. Here it is, clean and usable. First, accept that even if your thesis is right, price can whip around violently. That's normal. Second, decide in advance what is trend signal and what is noise. Trend signal is structural, holding key zones, buying pressure on dips, and coherent reactions to event risk. Noise is the intraday chaos designed to trigger your fear circuits. Third, don't let a single headline hijack your time horizon. In the next 2 weeks, you'll see every kind of emotional bait. Gold is crashing, gold is unstoppable, rate cuts are dead, rate cuts are inevitable, safe haven is over, safe haven is everything. It's all designed to get you to chase tops and sell bottoms. The antidote is a checklist. If the pivot shelf holds, the thesis is alive. If support zones hold on a retest, the thesis is alive. If a key resistance breaks and holds, the squeeze path is live. If those fail, you reduce risk. That's it. You're not marrying the trade. You're renting exposure based on conditions. That's how you stay solvent in a market that wants your emotions. Now let's go practical. What comes next in the next week or two specifically? First, watch the reaction to the inflation print. Not the number itself, the reaction. If inflation comes in hot and gold sells off, but instantly finds buyers and reclaims the pivot shelf, that SA strong tell that the market is more concerned about credibility and instability than about nominal rates. If inflation comes in cool and gold rallies, that's also bullish, but watch for sell the news behavior. Second, watch how price behaves into the central bank window. Markets love to front run and then reverse. If gold grinds higher into the meeting, you want to see whether it holds gains after the decision, not just before. Third, watch the liquidity tells. Overnight gaps, sudden spikes, and whether moves feel thin. Well, thin moves are dangerous because they can reverse hard, but they can also squeeze harder than you expect. Fourth, watch whether dips are bought faster than they're sold. This is simple to observe even without complex data. When pullbacks fail to extend and rebounds are sharp, buyers are in control. When pullbacks extend and rebounds are weak, sellers have the steering wheel. Fifth, keep your eye on the zones. Above roughly 4,600 with follow-through, the squeeze scenario becomes more probable. Below the mid 4,100, the pivot shelf and unable to reclaim, the market may want to dig for deeper support. If the low 4,300s area holds and rebounds reclaim the pivot, that's a classic reload. Say, if those supports crack and price stays heavy, that's your warning that something changed. Either positioning got too crowded or macro conditions shifted, or the plumbing eased enough that the urgency bid faded. That's your invalidation. You don't argue with it, you adapt. But here, that's the twist that most people miss. The scariest looking pullbacks often happen right before the strongest continuation because that's when the market clears leverage. So you have to separate pain from signal. Pain is the price of volatility. Signal is what remains after the dust settles. And that's where the real pressure starts. Now, I want to address the one thing that can make or break your next decision, the temptation to overtrade. In markets like this, the biggest psychological trap is thinking you need to do something every time price twitches. You don't. Your edge is patience plus a framework. If you're long-term bullish, your job is not to predict every swing. Your job is to avoid being emotionally manipulated out of your exposure. And the market will absolutely try. It will show you a sharp drop and convince you it's the start of the collapse, then reverse. It will show you a sharp pump and convince you you're late, then pull back. It will use your need for certainty against you. So build the shield, define the conditions that keep you in, define the conditions that get you out, and size exposure so you can survive the path. Because if you can't survive the path, the thesis doesn't matter. One more point for the metals crowd that is always scanning for real-world symptoms. Pay attention to the difference between hype and constraints. Hype is endless. Constraints are what move markets. Mining and refining don't respond instantly. Logistics don't scale overnight. Recycling doesn't surge smoothly. And demand can be lumpy, especially when institutions reallocate or when geopolitical stress triggers sudden bids. That means the supply chain doesn't have to run out for price to jump. It just has to get tight enough that participants are forced to pay up for immediacy. That's how commodities behave. And gold, when it's acting like a commodity instead of a sleepy macro hedge, can shock people who think it only moves in slow motion. That shock is part of why you see both loud bullishness and cautious quiet at the same time. Different people are managing different risks, and your job is to manage yours. So here's the final clean trust-earning wrap. We're in a regime where gold S move is being driven by more than sentiment, by the math of macro uncertainty, by the incentives of institutional positioning, and by the plumbing that connects paper to physical. The hidden detail is that spreads and financing reveal stress before spot does. The why now is the calendar. Clustered event risk plus thin liquidity plus positioning windows that can flip hedging flows quickly. The mechanism you must understand is that forced behavior, margin pressure, delta hedging, and arbitrage frictions creates discontinuous price moves that feel emotional but are actually structural. The proof stack is not one story. It's multiple layers, chart structure and zones, macro regime pressure, institutional permission and positioning, physical lock paper plumbing signals, global frictions, and the real-world tell of margin and volatility behavior. The roadmap is two scenarios: controlled pullback and retest, ugly but constructive if support holds and the pivot is reclaimed. Continuation squeeze, break and hold above resistance, fast acceleration and gap risk. Confirmation is holding and reclaiming key zones with dip buying. Invalidation is losing supports and failing to reclaim the pivot shelf with authority. And the psychology shield is remembering that volatility is designed to make you betray your own plan, so you pre-commit to a checklist and you refuse to outsource your conviction to headlines. If you want a simple identity-based CTA without the begging, stay in the group that watches the plumbing, not the pundits. Stay in the group that thinks in scenarios, not slogans. And in the next week, don't just ask what happened. Ask who was forced to do what, because that's where price is really born.